Hi. Hello.
All right, it's 12 o'clock. I think we are going to, I know we have our speakers here with us, and we're going to jump in and get this meeting started. We are recording this meeting, so we will have it if we need to send it out to anybody following the meeting, or if anybody's wasn't able to join us that had signed up for this. Again, my name is Eric Person, I'm the CEO of the Home Builders and Remodelers Association of Central Connecticut. I want to thank everyone for joining us. Just some ground rules. We are going to have everybody on mute during the course of the meeting. There is the chat box at the bottom of the screen. So if you have a question as the presentation is going on, please add your questions into the chat box. We'll moderate that with the speakers and get those going. And then at the end of the meeting, we'll open it up for some questions as well. But before we get started, I did want to introduce the president of the HBRA of Central Connecticut, Liz Cueva. Welcome, everybody.
Hi, welcome to everyone. It's wonderful to see so many faces. I thank you all for coming on for this very important seminar. Yeah, as you know, this is unprecedented times, but I hope you also know that the association has been working tirelessly behind the scenes to support everyone. As I'm sure you all have seen all the millions of emails and communication that's been sent out. I hope it's been helpful out to everyone. And please let us know if we can be of other resources to you. This presentation came because just last week in another council meeting, online Zoom meeting, someone brought this up, and within days Sheila had put it together with Eric. So it's amazing the work they've done behind the scenes to keep us all up and running and keep us all moving forward. And we're going to get through this all and come out better in the end.
Great, thanks, Liz. Again, this is a very special occasion. We're lucky enough to have Shipman Goodwin as members of the Home Builders and Remodelers Association of Central Connecticut. And some of you do some work with Shipman Goodwin, some of you know their work, but they are certainly some of the best lawyers and some of the top-notch lawyers in Connecticut. I did want to introduce, before we get to our speaker, Tim Hollister, who was is a partner with Shipman Goodwin as well. He is one of their permanent land use attorneys, does a number of things with the National Association of Home Builders. And if you write any of their legal issues or legal conferences, you will always see Tim there. So Tim, just want to welcome you and say a few things.
Well, thank you. Can you hear me okay?
Yes.
Great. Well, thank you to Eric and Sheila and the HBRA for giving us the opportunity to talk to you today. As you can imagine, our firm has been fielding calls about the program, Paycheck Protection Program, since it was even whispered by somebody at the Treasury Department. And we're only half kidding when we say that when people ask us a question about the program, the answer is often, what time is it? Because this is a program that has been evolving, weekly, daily, and sometimes even hourly. But internally, we do have a Paycheck Protection Program team. It's composed of people from our real estate, finance, corporate, and labor and employment practice groups, and all of those are all involved in the program. And the group is led by my colleague and partner, Mike Fritz. So I will turn it over to him. Thank you.
And I just wanted to let everybody know, Mike is gonna share his screen. He's got some slides that he's put together for this presentation. So he will be sharing his screen. You'll see the details coming up there as well. But as Liz said, this is something that came up with a number of members that I think we all have questions about a lot of the programs that have come out of the government, and they change, if not daily, hourly. And so again, wanted to thank Tim and Mike for working with us and putting this together. And Mike Fritz, I'm going to turn it over to you now.
Great, thanks, Eric. Before I start, can everyone hear me okay with a nod of the head? All right, great. So Eric, thanks for the intro. Tim, thanks for the intro as well. As Tim mentioned, this is a very dynamic area of our practice right now. Things are changing, daily and hourly, and it's, I seem to be getting an email from my colleagues at least multiple times a day with updates in either new guidance that the SBA or the Treasury Department has issued, or the IRS in certain circumstances has issued, or new developments in terms of lawsuits that have been filed against the SBA and or Treasury in connection with their administration of the program. So unfortunately, when we're counseling clients on these matters, it's a lot of the advice is, well, here's what the regulations say. Here's our best guess on how they're going to be interpreted, because the guidance is changing and ever evolving. One of the analogies that we've been using that is fairly appropriate for the kind of situation that we're in is, it's as if the SBA was building the airplane as we're taking off, right? So this is a hundreds of billions of dollars worth of financial stimulus that we're trying to get into the system, that was rolled out within a matter of weeks, and now we're into the second month of the program. We've already gone through $350 billion of the first tranche of PPP loans, and now the last number I saw, I think we're through high 100 billion, almost 200 billion on the next tranche. So very quick rollout for a very large product and project. So it's something that would have been wonderful if we had the foresight and the ability to spend a lot more time kind of working through the regulations and how this was going to be implemented. But unfortunately, we're not in that position. So, that's kind of we're going to do the best that we can. So I'm going to, in a second, I'll share some slides that I put together, really kind of focusing on not so much the process for applying for and receiving a PPP loan, but rather, steps that folks should be taking and thinking about when they're dealing with a PPP loan that they've received. But before we do that, again, my name is Mike Fritz. I'm a partner at Shipman Goodwin. I kind of share times and share space in the practice groups. I'm in our corporate / business and finance group. And then I also am in our real estate and environmental and land use and construction group as well. My practice kind of, I serve as, outside general counsel for a number of different companies in the real estate space. I do a lot of real estate equity investment and financing type work, and then also do some general corporate and finance work as well. We have a team of about 10 to 12 lawyers on our PPP kind of task force that we meet on a regular basis. Our last meeting was this morning at 8:30, where we try to keep up to date on, from the borrower side. So we have, folks like me who represent borrowers that are going through this process. We have other folks that are on the lender side that actually represent and are very closely tied in with the SBA. So we know exactly what some of the larger regional and national SBA lending institutions are doing in some of their areas of concern. And then also, as I'm sure most of you are aware, a lot of the forgiveness aspects of the PPP loan program has to do with employment and payroll costs and things of that nature. So we have a lot of insight from some of our top employment law colleagues and labor colleagues as well. So ever evolving area, and I'll keep an eye on the chats as well. And Eric, if you want to let me know if questions pop up, I'll happy to answer questions. I know we're slated for an hour and a half. We'll see if we how much we can get through. I think I'll be able to get through all my slides, but I'll try to leave some time for questions at the end. And just a little bit of a forewarning: some of these questions are going to be, sorry, we got to wait for some guidance to come out from the SBA and Treasury. So just bear with me one second. I'm going to share my screen now so you can see the slides. So let's see here. Okay. Can you just nod your head, make sure that you guys can see the slides? Everything look good? Okay, perfect. All right. So the first considerations that I wanted to go through was just how did we get to where we are right now, right? So let's provide a general overview of the Paycheck Protection Program. So the Paycheck Protection Program, was one of the main attributes of the CARES Act, which was passed at the end of March to provide some stimulus to the economy. The whole intention of the Paycheck Protection Program was to provide a stimulus for employers to retain and maintain their workforce. It tasked the SBA already had a program in place. Some of you might be familiar with Section 7A loans that the SBA provides to small businesses. And the Paycheck Protection Program piggybacks on that loan program, but makes some important exceptions in order to ease the administration of the program. So the general upshot of the program is that borrowers can borrow up to 2.5 times their monthly payroll expenses with a cap of $10 million. The loan proceeds, there are restrictions on how loan proceeds can be used. The loan proceeds can be used for qualified payroll costs that are itemized and outlined in the CARES Act and the interim final rules that the SBA has put forth. They can be used for rent payments. They can be used for utilities, and then they can be used for interest payments on debt obligations that were incurred prior to February 15th, 2020. There's a distinction which we'll get into is between allowable uses of loan proceeds versus forgivable uses of loan proceeds, but we'll get into that in a little bit further on in the presentation. The important aspects of the loan itself, the loan has a maturity date of 2 years and has an interest rate of 1%. So obviously a very favorable interest rate. And loan payments and interest payments are deferred for a period of 6 months after the date of origination. So from the date that you receive the loan for a period of 6 months, there aren't going to be any obligations to make any principal or interest payments on the loan. So what that does is that eases the cash flow burden on folks when they receive their loan. The main component which has made this so attractive to borrowers and applicants is the potential for loan forgiveness. So the way that you calculate loan forgiveness is still one of the items that, while some of the interim final rules in the CARES Act itself have provided guidance on how loan forgiveness will be calculated, there's still a significant amount of guidance that needs to be issued by the SBA in order to finalize the calculations of the loan forgiveness amounts. So the loan forgiveness is going to be based upon how you utilize the funds for a period of 8 weeks. You have to utilize the funds for specific payroll costs and other forgivable expenses, and you can only use some of the other the funds for things other than payroll costs and expenses. For 25% of the loan amount can be used for other allowable amounts. So that would include qualified, the rent payments, utilities, and interest payments. So 75%, the intent is that 75% of the loan proceeds need to be used for payroll costs. Adding to one of the areas of ambiguity in the administration of the program now is there have been some challenges to the SBA's interim final rules that contemplate that 75% of the loan proceeds need to be used for payroll costs, because the authorizing language in the statute, the CARES Act itself, doesn't actually specify a percentage of funds that need to be used for payroll costs. So that's one area in which we're already seeing some challenges to the additional guidance that the SBA has set out. So for this afternoon, what we wanted to focus on was, there's one impending date on the 14th that is May 14th, that it's on the forefront of a lot of people's minds right now. So what we wanted to do was focus on the things that you should be looking at after you've received your paycheck protection loan, right? So the main concern and what everyone's talking about, over the last several days and week or so has been some questions regarding certifications that borrowers needed to provide in the application process for the loan, particularly whether or not they actually needed the funds or whether there was a necessity for the funds at the time that they applied from the loan. So I want to get into that a bit because that's something that's on the forefront of everyone's thinking right now. Next, I'm going to go through some ideas and concepts on documenting and administering a PPP loan that you received. There are some best practices that we'd like to suggest that folks consider when administering their and using their PPP loan funds. Next, we'll get into a fairly high-level discussion on forgiveness of the PPP loans. Like I said, the forgiveness area is one where the SBA and Treasury have been promising additional guidance on, calculation of FTEs and considering reductions of salaries and employee headcounts. And additional guidance is going to be forthcoming on how those rules are going to work in practice. But as of 12 o'clock, when we started this presentation, that guidance hasn't been issued yet. We're expecting guidance to come hopefully today or tomorrow because of the May 14th date that we're going to talk about in a second. But as of yet, nothing has come out. And then finally, we'll close up with a brief discussion on some IRS guidance that was recently set out with respect to whether or not funds that have been used under the Paycheck Protection Program to pay for payroll expenses and the like are actually going to be deductible from a federal income tax perspective. And again, that's another place where the IRS has come out with guidance, but there's already a bipartisan push in Congress to essentially overrule that guidance that the IRS has set forth. So with that, we'll start with the concerns that I flagged with respect to the application and certification. So under the CARES Act, the actual statute that Congress passed, the applicants for a PPP loan are required to make several certifications about themselves and their use for their need for the loan. And the one that's giving folks right now a lot of heartburn and agita is the certification that the current economic uncertainty makes the loan requests necessary to support the ongoing operations of the applicant. One of the things to think about is when you're making these certifications or when you made these certifications need to be made in good faith, right? So good faith is the standard that we're looking at. And the overarching concern here is that if an application or a certification wasn't made in good faith or was misleading or fraudulent in the worst case, there are ramifications under the Federal False Claim Act for making false certifications to the U.S. government in exchange for the receipt of a payment of funds. And those claims under the False Claims Act could result in civil penalties and potential criminal penalties. So that's why folks are really focused on this certification. Like I said, the Department of Treasury and the SBA have continually been issuing additional guidance on how to interpret and how to apply the language of the CARES Act. And one of the most recent guidance that came out in the form of an interim final rule deals specifically with what it means to have the economic uncertainty make the loan request necessary to support the ongoing operations of the applicants. So what we're counseling our clients to do is, go back and take a hard look at your standing and your cash flow position, your liquidity position, at the time that you made the application to make sure that you're comfortable that, your certification was actually made in good faith. Some of the guidance that has come out was meant to provide some color as to what it actually means to have the funds be necessary to support the ongoing operations. So the FAQs that have been released in various iterations, provides that additional guidance. So what companies must consider is whether they have access to sources of liquidity that are sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. The example to provide some color for the readers of the FAQ that the SBA provided was, an example of a publicly traded company that has a substantial market value. If you're a publicly traded company and you have substantial market value, the idea would be that you'd be able to go out to the capital markets and raise the necessary funds that would be, or raise funds that would be sufficient to help you, maintain your business as an ongoing concern. So after those regulation or those FAQs came out, you've seen a fair number of publicly traded companies that have received PPP loans, repay those loans to the SBA and the federal government. The one that is on the forefront is Shake Shack, as the restaurant chain has received a significant amount of funds from the federal government, but under concern for this certification and also concern for just the public and political relations standpoint has repaid their funds. Where we're counseling clients with respect to this liquidity concept is a lot of our private equity clients, venture capital clients have portfolio companies that have applied for funds and received funds, and the question has been, are those companies really in a position to say that they've looked to their sources of liquidity and they don't actually have access to liquidity to support their ongoing operations? And the answer to that question oftentimes has been a conservative answer, which is said, well, Congress has actually come out later and said that, private equity funds and venture capital and hedge funds aren't entitled to receive these money from the PPP program. But the general thinking is that these are well-capitalized companies that have the ability to write a check to fund capital into their operating portfolio companies. So these are companies that should not be entitled to receive the paycheck protection loans. So you've seen a lot of these kind of companies actually return the money. But unfortunately, there's no real bright line test on determining, what is considered necessary for the purposes of, supporting your ongoing operations. Under the typical 7A loan program, there was a requirement that in order to receive a loan from the SBA under Section 7A, that you needed to be able to, have looked elsewhere to see whether or not there was credit available. And you would only be entitled to receive a loan under Section 7A from the SBA to the extent that there wasn't any other credit available. Now, the CARES Act expressly removed that requirement, so now there isn't an affirmative obligation for borrowers to go out and have made inquiries to other potential sources of liquidity, whether it's new investors or debt providers or what have you. So there isn't the obligation to make a determination that there isn't any credit available for you otherwise. But what the FAQs have said is that the borrower needs to take into account its current business activities and its ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not, and this is the important phrase, significantly detrimental to their business, right? So if you are able to actually go out and source a loan from a regional bank or a local bank or some other, alternative lending source, and the interest rate is exorbitant, while it wouldn't be usurious, but it's an exorbitant interest rate that's going to have a detrimental impact on your business. You still could qualify for being able to make the necessary certification. Significantly detrimental hasn't been defined, unfortunately, but this is a judgment call that folks are going to need to make to say, well, there is this access of, I do have access to this type of liquidity, whether through an investment or through debt financing, but the cost of that access to capital is so high that it's going to have a negative impact on my business. So that's going to allow folks some breathing room to make a determination that the PPP loan was more readily available than the other forms of capital. So the overarching question then is, what if we come to this position where we've received funds from the SBA in the form of a paycheck protection PPP loan, and we're not comfortable that we can actually make the necessary certification that these funds were necessary to support our ongoing operations. Some of the examples where this has come up with our clients is, like I had said before, in situations where clients are adequately capitalized, where they have a fair amount of reserves that are sitting in their accounts that they can tap. Some of our independent school clients and nonprofit clients have significant endowments that they're sitting on that they can actually tap in order to fund operations up to a certain percentage. And in those cases, they've decided that there is liquidity that's available that wouldn't necessarily be detrimental to their business to tap. So they're actually feel that they should be tapping that liquidity as opposed to the PPP loan program. So what the federal government has said is, we understand that there's been some confusion and uncertainty as to what it means to be, necessary to support the ongoing obligations. So the federal government has come out and said that we're going to provide a safe harbor to folks that have made this determination that they maybe didn't appreciate what the government was thinking about or considering in requiring this certification. So we're going to allow recipients of these funds to repay the loan to the federal government by, originally it was May 7th, but it's been extended to May 14th. And if you make this determination that you actually don't qualify under the program and you want to return your funds, you can return your funds. And if you do so before the 14th, you will be deemed to have made the required certification in good faith. Now that's important because it gets back to the False Claims Act question, right? Because if you're deemed to have made that certification in good faith, the likely result should be that the borrower should avoid any civil or criminal liability for making an incorrect or inappropriate statement or certification to the federal government. So as of right now, we have 2 days left. There's before the 14th comes and goes. We have a number of clients that we're counseling, this morning and this afternoon and tomorrow. About how they're going to be thinking about returning the funds or not, and the important thing is that if you have a situation where you're concerned about whether or not you qualified for these funds, to reach out to counsel and to have a discussion about whether or not you think you qualify, and if you do feel that you qualify and you want to retain the funds, what risks that you're going to have in retaining those funds. And one of the things that counsel should be advising you on is the best way for you to mitigate your exposure for potentially retaining the funds in a situation where it may be questionable whether you qualify or not. So one of the things that you should be thinking about is, how do we document that we've actually, satisfied this, necessary certification that the CARES Act has put out there. So the FAQs have stated that borrowers must be prepared to demonstrate the basis for their certification of necessity of the funds, right? So what does that mean? Some counsel that we've chatted with just kind of colloquially about what they're advising their clients have actually advised clients to put together a detailed memorandum that actually goes through their analysis on why they think these funds are necessary. And that's something that, folks are doing. And what they're thinking about is, while putting together this, this idea in concept of why they feel the funds were necessary in order to support their ongoing operations, is looking at what are the company's perspectives on the uncertainty of the economic conditions, right? So what does COVID and the government shutdown mean for you specifically? What does that mean for your business? Have you been in a position where you've had to be shuttered for the last 2 months? Have you been able to operate under limited conditions, and maybe your revenue is taken a hit, but it hasn't gone completely away. What do your operations look like? What are your sources of liquidity that you have at this given time? Are there any other sources that are available? What are those terms? Documenting these things and having these types of information readily available will go a long way when you have to defend yourself at some point, or you may have to defend yourself at some point in the future about whether or not your certification was accurate. While there's been no formal guidance, Treasury Secretary Mnuchin has come out and said that one of the things that you need to be concerned about is potential audit risk, right? So the Treasury, the SBA and the CARES Act has specifically identified for lenders exculpation provisions and hold harmless provisions that effectively said that you SBA lenders, when you're making determinations of whether or not to actually send out these or to issue these loans to potential borrowers, you only have to rely on the certifications that the borrowers provide you. Typically in a lending creditor-debtor situation, you have a lender that's going to do a full underwriting of the borrower, look at the borrower's financials, look at the borrower's information, ask questions, and fully underwrite the loan. Because the SBA needed to get these funds out so quickly, and Congress realized that the funds needed to get out very quickly, they've essentially punted, the regulation of whether or not these borrowers, satisfy the requirements of the CARES Act and the PPP loan program from the SBA to the borrowers themselves. So the SBA lenders are going to be exculpated and held harmless by the federal government for relying solely on the borrower's representations and certifications with respect to their eligibility for these loans. So in response to that, you've seen the Treasury Department has come out and said that loans that have been issued to borrowers in excess of $2 million are going to be subject to an audit. So the idea is like anyone who's received loans in excess of $2 million will be subject to an audit by the SBA. Loans that are in amounts less than $2 million may be subject to audit as well, but are going to be on more of a spot random basis. Now, the question that you should be asking is, the SBA, generally speaking, was somewhat understaffed coming into this situation, and now you have upwards of over $6 billion worth of loans that are coming in under the SBA umbrella. Does the SBA actually have the ability to audit all loans in excess of $2 million and then do spot audits for loans under $2 million? I think the answer to that question is no, they don't have the ability to do that. But it is important to note that while the SBA may not have the bandwidth to fulfill, this promise by the Treasury Secretary that they're going to, do all these audits, there are other mechanisms for, for borrowers to be held accountable. Just this morning in the Journal, Wall Street Journal, there was an opinion piece, stating that the Justice Department is already starting to look at potential fraud and abuse issues with respect to the PPP loan programs in terms of borrowers overzealously stating what their payroll costs are in order to increase their loan proceeds. So you have the Justice Department that could potentially be looking at enforcing the False Claims Act, and there's also standing for individuals to bring claims under the False Claims Act as well. So It's important for companies that are recipients of these funds to take a hard look at this application and certification issue, and make a determination on whether or not they should keep the funds based upon what their individual financial status was as of the time of their application. And like I said, this isn't something that you necessarily need to do on your own. Any counsel that works in the SBA area or the creditor-debtor area is going to be, should be well versed in this. So that's something that they'll be able to help you make a judgment on. And when we were talking with Sheila and Eric about when we should kind of schedule this PPP call, because of the impending May 14th deadline for returning the funds, that we wanted to make sure that we got it on as early in the week as possible. Just one quick little side note before we move on to the next concept, which is going to be the documentation and administering the loan, is that there is still guidance that folks are expecting the SBA to come out with in the next day or so, and that guidance was actually promised over the weekend. So on Friday they actually formalized an amendment to one of their initial interim final rules that set the safe harbor date back to May 14th. There is some thought that maybe if the additional guidance isn't provided in the next couple of hours, that maybe the SBA will be in a position where they have to extend the safe harbor date again by another week. But that hasn't come back yet, so I wouldn't necessarily rely upon that. But there is some chatter out there that if guidance doesn't come out quickly, that so an additional extension of the safe harbor period may well be warranted. Okay. All right. So that's the application certification concerns. That's probably one of the more timely and important things to kind of think about before we kind of get into the actual questions of actually documenting and administering your PPP loan that you've received. So one of the things, because there's going to be this obligation to demonstrate the necessity of the loan, it's going to be important to keep an organized file of what's that relates to your PPP loan and matters revolving around your PPP loan and its forgiveness. So obviously one of the main things that you want to make sure that you retain are copies of your loan application and the actual loan documents, right? So that's going to be your note and any other resolutions and certifications that the SBA lender asks you to retain. As I noted above, to the extent that you have put together an analysis of or a rationale for justifying why your funds you can certify the necessity of your funds, you should keep that information in your PPP loan file as well. And then also any correspondence that you have with your bank, during the PPP loan application process. That's going to be important as well. And as we get into the forgiveness issues a little bit later in the presentation, you want to make sure that you're maintaining proper documentation on what payroll expenses you're paying, what non other allowable expenses that you're paying, rent, mortgage, interest, so on and so forth, to make sure that you can document appropriately your forgiveness request when you actually submit your forgiveness request. So in terms of just some best practice on how you should actually administer the loan, so this is a little bit different than keeping a file, but how you should actually hold the funds and expend the funds. One of the things that we've been discussing with our clients is that in order to make the accounting more efficient and more clear, we've been suggesting to our clients that to the extent feasible, they open up a separate bank account to hold just the loan proceeds. So, money is fungible. So if you've got a loan that came in the amount of $1.5 million or something like that, and that just goes into your operating account, It's hard to really kind of delineate, which which funds have been used to actually pay payroll expenses, whether those are your funds that were already in there or whether those were PPP loan proceeds. So we've been suggesting to our clients that they maintain a separate bank account to deal specifically with, PPP loan proceeds and the payment of costs with those loan proceeds. So in order to do that, obviously, because 75% of the loan proceeds should be used to pay payroll expenses, you're going to need to coordinate with your payroll provider. So if you use an ADP or some other Paychecks or some other payroll provider, you should make sure that they understand that there's a new account that they should be debiting in order to make your payroll payments and your health insurance payments, and give them that information so they're deducting the payments appropriately from the funds from the PPP loan. And I think this goes without saying, but it does make sense before any loan funds have been expended to come up with a plan on how you're planning on using those proceeds, right? So you want to make sure that you utilize the expenses, obviously, the funds for expenses that are permissible, right? Because if you knowingly use the funds for something that's not a permissible use of funds, that could result in liability under the False Claims Act as well. So you have, again, the reminder is, qualified payroll costs, rent, utilities, and then interest on debt obligations. So you want to make sure that you have a plan that's set out saying, here's the amount of the loan proceeds that we received, and our plan is over the next 8 weeks that we're going to use those funds for 75% of the loan proceeds. We're paying X, Y, and Z employees. Rent, we're going to use for this much money for rent and this much money for utilities. So having that plan set up in advance will allow you to be comfortable that you're actually going to be able to maximize your potential forgiveness of debt, and also make sure that you're not using the proceeds in a manner that's contrary to the requirements of the CARES Act or the regulations that have been set forth by the SBA. And again, so the forgiveness, and we're going to get into this on the next slide. The forgiveness is truly based upon a cover period of 8 weeks after the date that the loan was originated. So you're going to want to focus when you're coming up with your plan for use of funds. You want to focus on the 8-week period after the loan has been originated. So make sure that you're using the funds in a way that maximizes your loan forgiveness over that 8-week period, because anything that's used after that 8-week period is not going to be counted for for loan forgiveness. So those will be subject to repayment of principal and interest at the 1% rate. Okay. All right. So loan forgiveness. So loan forgiveness is probably one of the most complicated, or the most complicated area in the PPP loan program. And it is, unfortunately, the area where the SBA and other agencies need to promulgate some guidance on how to actually calculate the loan forgiveness in practice. All right. So the main thing to think about is these are what I've set forth in the slides that follow are the main concepts and constructs under which loan forgiveness will be applied. However, how they're actually going to work in practice is still up for further explanation and guidance by the SBA. So the main thing to think about is what is going to be what's going to impact the amount that our loan is going to be forgiven. So the main thing to think about here is the usage of funds for payroll costs and other forgivable non-payroll costs versus allowable costs, but not forgivable costs. So there's a little bit of a distinction here. So the allowable purposes or allowable costs for which you can use a loan are broader than the forgivable purposes. So you kind of think of it in two buckets. So allowable purposes or allowable costs are payroll costs, our interest concepts that we were talking about, rent, and utilities. All right. So the amounts from that bucket, then we narrow it down further to which of the allowable purposes are actually forgivable purposes. And I didn't go through all this detail on the slides, but I think it's important to spend a little bit of time talking about it. So allowable purposes are broader, forgivable purposes are narrower. So all payroll costs that are allowable costs are going to be forgivable, okay? Interest payments are only forgivable to the extent that they were incurred prior to February 15th, 2020. Rent payments are only forgivable to the extent that they arise under a lease that was enforced prior to February 15th, 2020. And utilities and payments for utilities are only forgivable to the extent they're used for services which began prior to February 15th, 2020. So what you have here is this dynamic, whereas you can use these proceeds for all of these allowable costs, but only certain of those allowable costs will be used when calculating how much forgiveness you're going to be entitled to. So on top of that, you have, the general overarching rule is that 75% of the loan proceeds must be used to pay payroll costs, right? So all payroll costs that we talked about before, those are going to be subject to forgiveness. Up to 25% of the remaining amount of funds can be used for other allowable costs or purposes. Now, then we get into the question of your rent costs, utility costs, and interests. You can use them for allowable purposes, but just because they're allowable doesn't necessarily mean that they're going to be forgivable. So you have to look at which aspects of interest payments, rent payments, utilities are actually going to be forgivable. So there's a little bit of a calculation that you need to go through there in order to make that determination. The costs need to be incurred for forgiveness purposes, need to be incurred for payments that are made during the 8-week period after the loan has been originated. So you have a period of 8 weeks from the time that the loan hits your bank account to spend the funds in order to receive forgiveness. So all payroll costs that you make during that 8-week period are going to be subject to forgiveness. And then up to 25% of the other costs, to the extent that they're forgivable, that are made during that 8-week period are also going to be subject to forgiveness. After that 8-week period has run, and you've been able to account for those costs that you've paid, that's when you're going to be able to apply to your lender for forgiveness. And the lender will look at your certifications and documentations with respect to forgiveness. But again, similar to the way that they were able to rely on your certifications for advancing the funds, they're also going to be able to rely on your certifications for forgiveness. So again, this is somewhat of a self-regulating calculation and self-regulating program as well. Okay, so if we assume that you've used all of your funds for forgivable purposes, there is another aspect of forgiveness that comes into play when talking about forgiveness. And whether or not the borrower employs fewer full-time employee equivalents or reduces salaries for employees during the 8-week period after loan origination can result in your forgiveness amount being reduced, right? So you start with the slide before we go through. We look at our expenses that we're paying, and we calculate what our forgiveness amount is. And then if we've have a reduction in staff in our FTEs, or we've reduced the salaries of employees during that 8-week period, our forgiveness amount is going to be subject to reduction. So the forgiveness amount of the PPP loan is reduced proportionately if the borrower employs fewer FTEs on average per month during that 8-week period compared to one of two comparison periods. All right, so we can look at what our average employee FTEs were for the period of February 15th, 2019 through June 30th, 2019, or the period from January 1st, 2020 through February 15th, 2020. The reason that we provide the SBA is provided for two separate comparison periods is to allow for seasonal employees, right? So to allow the people who have seasonal employees to pick the period that's better for them. So we have ideally a borrower should just pick whichever, from their perspective, whichever comparison period has the lower FTE average, right? Because that allows you to make sure that, you know, in comparison, your FTEs are going to be hopefully greater than what the comparison period is, or equal to or greater. But to the extent that you do not maintain FTEs, or your FTEs on average fall below what the comparison period is, your forgivable amount is going to be proportionately reduced. Now, the issue here, like I said from the beginning, and I'm sounding a bit like a broken record, is that the SBA still needs to come out with guidance on how to calculate FTEs and how these FTE comparisons are going to work in practice, and work once you kind of get into the application of these to particular scenarios. So we're still waiting for that guidance, but you know, that's something that's going to need to come out in the next, you know, hopefully, you know, day or two, in order to provide some guidance, because we have situations where, you know, people have received their PPE loans weeks ago and they're paying expenses, and they still don't have a whole lot of information upon which to base their FTE calculations and calculate their forgiveness. Also, to the extent that the borrower has laid off employees between February 15th and April 26th, if you rehire those employees during that, before June 30th, the rehiring of those employees is, or the release of those employees originally won't count against your FTE calculations. Okay. All right. So there's also the question of whether or not there's a reduction in salary, right? So it's not only a question of maintaining your average FTEs during that 8-week period. It's also a question of whether you've reduced the salary of certain individuals. So individuals with compensation in excess of $100,000, they're not subject to these reduction caps. So you can reduce folks with compensation in excess of $100,000 without fear of affecting your forgiveness. However, for individuals that have a salary at an annualized rate of less than $100,000, if you reduce their salary by more than 25%, the amount by which the salary reduction exceeds 25% of their compensation, their annualized compensation, is going to reduce the amount of forgiveness that you have. Again, similar to with the FTE calculation for the proportionate reduction of your forgiveness, you calculate your loan forgiveness above in the prior two slides, and then you would apply this further reduction to the forgiveness based upon whether or not you've actually reduced the salary or wages of employees with comp less than $100,000. Similar to the FTE calculation, the wage reduction calculation is also subject to providing additional guidance by the SBA. So how that will actually work in practice is still subject to further guidance. So again, another area in loan forgiveness where we're looking to the SBA to provide us some more information on how we are going to be calculating the forgiveness of our debt. Okay. And then just bringing it on home, and then we'll leave a fair amount of time for questions, because I do see that there's a handful of questions that have come in on the chat. So the last question is whether or not funds that we use for through the payroll protection program loans, whether those funds and expenses paid with those funds are going to be available for tax deduction. So obviously one of the benefits of the loan forgiveness program is that the actual forgiveness of the loan itself is not going to be considered considered income for the purposes of your federal income tax. If we were looking at any other creditor-debtor relationship, when a creditor forgives a debtor's loan, forgive or cancels a debtor's loan, that cancellation or forgiveness of indebtedness is actually considered income that a borrower needs to record on its state and federal income tax. So you are actually taxed on cancellation of indebtedness. What the PPP loan forgiveness program does is it creates an exception for payroll protection loans that have been forgiven. So to the extent that your loan is forgiven, you no longer have to pay the lender back the amounts of the loan, and you do not have to pay taxes on the amount of loan that has been forgiven. So now that raises the question of, if you are not going to be taxed on the cancellation of indebtedness, should you be able to deduct from your income expenses that you paid with the loan that has been forgiven? And the IRS late last week came out with guidance in a notice that essentially says that any expenses that are paid with proceeds from a PPP loan that is forgiven will not be permitted to be deductible for federal income tax purposes. So the idea here is that the IRS does not want to be in a position, or doesn't want to be in a position, where there's both a tax benefit of receiving or not having to include cancellation of indebtedness as income, and then also being able to include expenses as a deductible expense based upon that forgiven loan. So the IRS's guidance is based upon Code Section 265 for those of you that are following at home with your code books. And 265 essentially provides that in cases where a taxpayer receives tax-exempt income, expenses associated with that income are not eligible for tax deduction. So the IRS is trying to eliminate this, kind of double dipping on the tax benefit by saying that, these expenses should not be subject to deduction as well. And that's somewhat contrary to the intent of the PPP loan in its inception, which is, the Congress was really looking for a way to get funds into small businesses in order to spur economic growth and to maintain employment levels across the country. So very quickly after the IRS issued this guidance, a number of senators have actually already come out, and representatives have already come out challenging the IRS's position and saying that, no, we disagree with the IRS's position. Not only should the loans be forgivable, but also the loan should be subject to, or the expenses paid with those loans should be subject to being deductible by the borrower. So what we're looking in, and our tax folks are closely monitoring, is what additional legislation is going to come out that essentially overrules the IRS's position that these funds should not be deductible. So we should stay tuned on that. Fortunately, we've got a little bit of time before our 2020 tax returns are going to need to be filed. So there's a lot of time for this to pay out. But the general thinking is that the IRS will likely kind of overrule, will likely be overruled by Congress, and these expenses, payroll expenses, interest, rent, utilities, so on and so forth, they're normally deductible. They should still likely be deductible after everything is all said and done. But given the state of play right now, these amounts are not going to be subject to be deductions. So Eric, with that, I will I'll stop my sharing, and that's like we can pause for questions. And we always have to have this little disclaimer at the end here that the materials that we've provided on the share screen, they're really just for informational purposes, and we're not intending to create provide legal advice or create a attorney-client privilege relationship. So if you have any questions, feel free. We can ask them now, and then feel free to reach out to either Tim or I, and we can put you in contact with the appropriate folks at the firm. So I'll stop there, grab a drink of water, and Eric, I'll throw it over to you.
Great. Thank you, Michael. That was very informative. I greatly appreciate it. And I think certainly went to a lot of great detail that I think, this, as you said, they kind of were building the plane as they were flying this thing. And I think a lot of these details have been coming out and trickling out. So I greatly appreciate you guys offering this advice and guidance. We have had a number of questions come through. So if you do have questions, you can just add them to the chat box there. But I think we'll go back up to the top. And Barbara had asked, if you receive PPP funds, can you take money from unemployment and not have that affect the PPP fund money?
So there's so take money from unemployment. So I guess the question for that is, there are rules that have come out in terms of Leave Act and whether or not expenses for leave are going to be can be offset by the amounts of the PPP loans, and the answer to that question is no. That to the extent that you're paying leave under the new Leave Act for the coronavirus, those funds are not going to be subject to offset by the PPP loan. I'm not sure I necessarily follow the question with respect to unemployment. So if you receive unemployment funds, I'm not sure if this is in a self-employed context or what, but I'm not sure I necessarily follow what the question is with respect to receiving unemployment funds individually, because the payroll protection programs are going to corporate to companies and entities generally, although there is some room for self-employed individuals to receive PPP loans as well.
Yeah, I think we saw one of those questions about self-employment coming up, so we'll maybe address that there.
Sure.
Fran had asked, will prepaid rent qualify as forgivable, and how many months of prepaid rent?
Yeah, so there's no specific guidance on prepaid rent. So the main test for calculating the forgivability of the loan is going to be the rent payments that are made during the 8-week period after the loan origination, right? So first and foremost, the lease needs to have been in effect prior to February 15th, 2020, right? And then the question is, what is the date that you've received your loan, right? Because that origination date starts the 8-week test period or the 8-week cover period. So you're going to be, from a forgiveness perspective, that's when you can actually use the rent, proceed or the proceeds to pay rent and use that for forgiveness. So you wouldn't be able to pay more than 2 months rent and have that count for prepay more than 2 months rent and have that count for forgiveness. But you do have the overarching theme or rule of 75% of the loan proceeds need to be used for payroll costs. So you have to, if your prepaid rent for 2 months is less than 75%, and that is your 25%, I think prepaid rent up to, during that 8-week period would be subject to forgiveness. But you still have the overarching governor of a 75% threshold needs to be used for payroll costs.
Okay. Next one, I've heard this question answered or asked a couple of times in the media, but can you use the PPP funds for independent contractors or office help?
Yeah, so that's a good question. So for forgivable loans, for it to count as a forgivable loan, you are not permitted to actually use it for independent contractors. Now there's a lot of information out there regarding the way in which the PPP loans kind of are used through, like if you have a PEO, which is an entity that actually uses that you lease employees from, and that's permissible. And if you can, under certain property management and management agreements, you're allowed to actually count those employees as your own employees, especially if they're solely working for you. But independent contractors, unfortunately, are excluded from the employee FTE counts.
And they should apply on for themselves.
Yes. Yep.
Another one, I've applied for PPP for self-employed. It would be helpful if you can address that aspect as well.
Sure. So there's specific guidance that's been that the SBA has issued on self-employment, self-employed and self-employment and sole proprietors, having access to the funds. I'm going to be completely honest with the folks. I haven't actually dealt much with self-employed individuals and sole proprietors, accessing the program. So I don't want to speak out of turn and provide you with any false information. But Eric, what I can do is I can provide you with the interim final rules that the SBA issued with respect to self-employment and sole proprietors, and send that to you, and you can provide that to the individual that asked the question. And then what I can do is, if there's a follow-up, I can put that person in contact with someone in our office that specifically deals with the sole proprietors and self-employed, if that can work for you guys.
That would be great. Thank you. Next question is qualified payroll confirmed as gross payroll and Connecticut unemployment compensation only?
Okay, so the things that qualified payroll, right? So the things that that don't count, I mean, we can do it that way. It's probably easier to say things that don't count rather than what actually does. So amounts, cash compensation that's in excess of $100,000 annualized is not included. So you can count up to $100,000 for highly compensated employees. Anything over $100,000 is not included. It doesn't include taxes that are payable for Social Security, Medicare, or the employee and employer portions of that, and then also for any employee withholdings. If one of your employees' principal place of business is principal residence is outside of the United States, any compensation that's paid to that individual is not considered qualified. And then to my point before, qualified sick leave wages and family leave wages, which you receive as a credit under the Families First Corona's Response Act, those types of expenses are not included as qualified payroll expenses. So otherwise, everything else would be considered qualified payroll expenses. So that includes health insurance benefits and things of that nature. But I think the crux of the question was, will those taxes that I mentioned be considered qualified payroll? And the answer to that question is no, that Social Security and Medicaid taxes or Medicare taxes are not considered qualified payroll expenses.
Great. I think that answers the next question, was what is considered payroll cost? I think you've covered that one there. If you have a home office, what's the percentage you can use towards utilities, et cetera?
No, there's no federal guidance on that. But what I would suggest is, especially, to be consistent with, the taxing, right? So with your taxes. So I would chat with your accountant, and, it's best not to take inconsistent positions. So to the extent that you're taking a certain position for allocations for home offices and the like on your taxes, I think you should take a consistent position with respect to allocations for the PPP loan program. Again, hasn't been any direct guidance that I've seen, but that's the way that I would approach it. The lawyers are important here, but then I should also say, with deference to other professional folks out there, the accountants are also really important for this as well. So we work with a number of accountants. Cohn Resnick we work with a lot. Bloom Shapiro, Markham, those folks. We're constantly chatting with them about how they're interpreting these rules as well. So lawyers, I'd like to say that we've cornered the market on this, but your accountants are also an important resource for you when coming up with your plans, particularly if you're coming up with plans on how to utilize the funds to pay payroll costs and the like, your accountants are going to be a very useful tool in coming up with your plans and your calculations on your forgiveness.
Right. We have one, just clarifying, I think that you're recommending opening up a separate bank account for payroll for the 2-month period, which it sounds like you are.
Yeah, I think that's right. That's not a hard and fast rule, and that's not something that's necessarily required by the Act or any of the guidance. That's just something that, you know, from our own perspective, we think it's prudent for recipients of the funds to be able to track which resources were used to pay which expenses, right? Because you want to make sure to create as clean of a paper trail as possible, especially if you get into a dispute regarding forgiveness at some point down the road. It'll be a heck of a lot easier to track, use of your funds if you've only got the funds in one account and expenses being paid, certain expenses being paid out of that account. So I think that's a best practice. Maybe that's not, maybe the ship has sailed for some folks, so I wouldn't be overly concerned if you can't do that. But if you haven't expended your funds yet and you're in a position to open a segregated account, I think it's well worth the extra, couple bucks that it's going to cost in terms of bank fees to open that account up.
Yep. On payroll, how about new hires or increases in pay due to working more hours and taking more of a workload?
Right. So to the extent that you, so if you have, let's take an example. If you have a certain number of FTEs for whatever your comparison period is, and for whatever reason your business has gone, you're in one of the fortunate scenarios where you've got a lot of extra work that you actually do, and you increase your FTEs, right? So increasing your FTEs isn't going to multiply or increase your forgiveness. That'd be great if it could, but it's really the question of whether or not your FTE levels fall below what the average is, because if you fall below the average, that's what's going to result in a proportionate decrease in your forgiveness amount. Increasing your levels isn't going to multiply or increase your forgiveness level.
Steve was asking, can you accept an EIDL loan if you've already received a PPP loan if you're not using EIDL for payroll costs?
Yeah, so that's a very good question. So you can accept an EIDL. So the EIDL loans are a different program that was already in place under the SBA, and the EIDL loans. I always mess up the acronym, but it's economic injury disaster loan or something to that effect. Those loans are available for a little bit more flexible in terms of what you can use the proceeds for. EIDL loans can be used for, a little bit, aren't as focused on payroll, more general corporate purposes for, accounts payable and things of that nature. The maximum amount of those loans are up to $2 million. There's different rules for that. Those loans, could be subject to collateral and the like, whereas the PPP loans are non-recourse loans with no collateral, no guarantees or anything of that nature. The way that the EIDL loans work with a paycheck protection loan is if you have an EIDL loan already outstanding as of the date that you apply for a payroll protection loan, that EIDL loan is essentially refinanced by the paycheck protection program. So you need to comply with how you utilize the funds under the EIDL loan program, but then that EIDL loan amount is used when calculating how much funds that you're going to be entitled to borrow under the paycheck protection program. So you're going to essentially refinance out the EIDL loan with the paycheck protection program. But using the funds under the EIDL loan for permitted purposes there should not affect your forgiveness under the paycheck protection program.
Great. There's a question about, is there advice for a reduction in workforce because of an untimely death of an FTE?
Yeah, so I don't think, and that's a really good question. So I don't believe that there's any specific guidance that has been issued because of a death or other separation, death, disability, what have you, other separation in service between an employer and an employee. let me, Eric, I'll put that on my follow-up list to see if, and that's a question. That's why our team is well suited to answer these types of questions, because that's more of an employment law question and how the employment law kind of aspects kind of fall into this. So I'll reach out to my colleague that's on our task force, Dan Schwartz, that has been focusing on, the employment law aspects, and I'll raise that question and I'll be able to get back to you with some guidance on that. So let me just take a note on that.
Sure, that'd be great.
Okay.
Another one was, if you receive PUA or FPUA as a self-employed person, is the PPP considered income?
All right. Sorry, I was just taking a note. Can you
sorry. Yeah, if you receive PUA and FPUA as a self-employed person, is the PPP considered income?
So the PPP the PPP should not be considered income, especially from a forgiveness standpoint. But let me file that one as well, Eric, under the point I was following up on under the self-employment and sole proprietors, because that that one's a little bit out. I'd be a little bit out over my skis trying to rationalize an answer for you, and I don't want to provide any incorrect info, so I can bring that one back. As well.
Okay, that would be great.
Yep.
Steve was asking, can the owner pay his or her salary from the PPP funding? And he wasn't sure if that was addressed in the presentation.
Yeah, I think the answer to that question is yes. As long as you're an employee of the entity, you would be considered one of the employees that would be subject to payments. The one thing to kind of keep in mind there is the the $100,000 rule in terms of when you were calculating the payment amounts. So if your comp is over $100,000, you weren't allowed to include that in your calculation of payroll costs for the loan amount. So that's one thing to think about there.
Okay, and Terry's asking, what do you recommend for companies whose fiscal year ends on June 30th in regards to expenses being deductible or not? And they're still waiting for the guidance to come out on that.
Yeah, I mean that one's a tough one. So again, I'd reach out to our friends across the aisle on the accountant side of things to kind of work through that question. But as it stands right now, so we do have a solid month and a half for Congress to come back and overrule the IRS. But as it stands right now, to the extent that you receive loan forgiveness and you used forgiven amounts to pay expenses, the IRS is taking a position that those expenses are not deductible. So I think what your accountants will likely say is you'd likely have to, absent any other action by Congress, you'd have to file taking the position that those funds are not deductible. And then, to the extent that additional guidance comes out in the future, file an amended return.
George is asking if you can address the issues of builders who build spec homes as well as contract homes. Also, if you have construction financing in place tied to cover the cost of construction, do those construction lines count as alternate means of financing?
Yeah, I mean that's an interesting question because we've dealt with that. I represent a student housing developer that raised some similar questions, and I mean I think the important thing to remember here is what the allowable use of funds are, right? So you only have a certain amount of you're not going to be able to use PPP loan funds for hard costs, for soft costs in terms of engineering and any other type of soft costs that you're going to have on a project. So what I would say is if you're looking for a PPP to kind of bridge a project for you, the PPP loan is not the vehicle for you to use that. Now, if you're thinking about it on the flip side, which is I have a construction loan outstanding. I can make draws under this construction loan in accordance with whatever budget I've provided to my lender. Does that count as an available source of liquidity? And I'd say I think you need to think about that carefully because it all depends upon what your line items in your development budget and your project budget say. To the extent that you have the ability to draw on a project on a construction loan to cover your overhead expenses, which would include your employment, I think that's something that you should think about in terms of whether or not you actually need a PPP loan, or whether or not you have the ability to certify that the PPP loan is necessary to pay your expenses in order to keep the business ongoing. So I would look at specifically at your development budget, look at your draws, and if you can draw to pay overhead, I think that is an additional source of liquidity that you should think about. But I think just generally, given my experience with the way that the construction financing works, that more likely than not, that money is already spoken for. So to the extent that you have general overhead expenses that you're covering for your back office and things like that, I think you will be able to say, or you should be able to say, that your PPP loan is necessary, because that wouldn't have been an adequate source of financing for you.
And I think the first part of that question too was whether, because I know that some of the SBA conversations we've heard is that they preclude spec home builders from accessing a lot of the SBA loans because of the speculative nature of that kind of business. Do you know if that would qualify, if you're building both spec homes as well as homes under contract, would they be able to access the PPP?
Yeah, so what the SBA has done is there are requirements that to the extent that you are one of the individual businesses that are excluded from SBA loans generally, that you would be excluded from this program as well. So there's a list. If you kind of go through, if you look at the CARES Act itself, there's a list of a certain identified types of businesses that aren't going to be eligible for SBA loans or CARES Act loans. If you're one of those businesses, then yes, you would be excluded. So if spec homes fall under that one of those excluded categories, then I think the answer to the question is yes, that you would also be precluded on the PPP loan basis. The issue where you can usually get comfort from SBA loans in the past was that the SBA itself is going to do its underwriting and administer the loan program. But like I said during the presentation, what Congress has done and the SBA has done has effectively kicked the determination of whether or not you satisfy the eligibility requirements to the borrower itself. So the borrower has to self-certify that it meets all of the requirements for this PPP loan program, and that's where if you have received funds and it turns out that you are an individual or a company that isn't eligible, that this safe harbor could hopefully also provide you some ability to pay the funds back as well.
Okay. There's one, and I think I know the answer to this, but they asked, I received the PPP funds and want to apply for self-unemployment. So can I do both? And it sounds like you cannot double dip. Mm-hmm. Okay. If we hire 2 additional employees to assist with marketing, will their payroll expenses be forgiven?
So, and again, the question goes to it's not for an individual employee per se, but you have to look at your FTEs, your average FTEs over the 8-week period, versus the average the FTEs over the comparison period. So as long as you're using your money for payroll expenses and they're qualified payroll expenses, those monies should be forgivable. But you have to make sure that you don't have any reduction in forces otherwhere, or a reduction in FTEs in another scenario where your average has fallen below the test period, because in that case you're going to be subject to the proportionate reduction. So if you bring an employee on, you're not going to be able to increase the amount of forgivable amounts, but their costs and payroll expenses should be forgivable as long as you don't have a reduction of the overall average of FTEs.
Question, if an employee has COVID-19, can he be paid with PPP loan funds as sick leave?
The answer to that is Yes, but you won't be able to be able to receive those as forgivable funds, right? Because one of the carve outs for payroll costs is qualified sick leave wages and qualified family leave wages for which a credit is allowed under the Families First Corona Response Act. So you're not, that's not going to count towards your forgiveness though.
Okay, and we do have a few more, and we are gonna end this at 1:30, just out of respect for your time and appreciate
Sure.
you doing, but hopefully we'll get through a bunch more of these. The question of, you said that payroll taxes are not considered qualified payroll expenses that would be considered forgiven. I was under the impression that they are to be considered qualified and forgivable. Please clarify.
Yeah, so payroll costs, as they're defined in the CARES Act, don't include taxes that are paid under IRS Code 21, which are Social Security and Medicare taxes, which is both the employer and the employee portion. You know, Section 21, which are railroad retirement taxes, which aren't going to be applicable, and then applicable here, and Section 24, which are, you know, employee withholdings. So under that framework, payroll costs do not include those taxes.
There's a person, say, interior designer, LLC owner of a company, and she wants to know, if I didn't take a specific draw per month, am I eligible to take a draw now?
I think you're still, I mean, you're still going to be eligible to take a draw, right? So I guess the question is, if the concern is about liquidity, right? So there's a couple of different ways to kind of think about this question. If the concern is about, you know, your ability to make the certification that you actually needed the funds, I think if you were operating previously under a scenario where you weren't, you know, considering yourself an employee, you weren't taking a monthly guaranteed payment, and then you have the funds come in, and then you take a guaranteed payment, I think there are some questions that could pop up about whether or not you're using the funds appropriately in order, you know, and that you've made the certification that you actually need the funds, whether you made that certification in good faith. So I think there's that concern. And then the question is, from an employment from an employee cost perspective, if you haven't consistently been an employee, quote unquote employee in an LLC that's been receiving employment costs or employment payments, I think you might have some concerns, you know, saying that you should be entitled to them now as well.
Okay. This is kind of follow up to the EIDL PPP loan question before. It said it was answered as far as a company that already received an EIDL loan before getting a PPP. They'd like to know, can you still apply for an EIDL loan after you have already received a PPP loan?
My understanding, I don't think that you'll be precluded. You can only apply for one PPP loan. I don't think that you would be precluded from applying from an EIDL loan. But let me check that, and I can confirm that and get back to you. But I don't think that there would be something that would preclude you from applying from an EIDL loan, because the EIDL loans, you know, are used for different purposes. But you may be limited in the amount that you're able to apply for. But Eric, I can come back to you on that one.
Okay, that'd be great. Question is, do I need to declare the PPP to the PUA?
Remind me, PUA stands for?
That's a good question. I'm not sure either. So we'll come back if they can follow up on that one. Sure. Question is the paycheck I pay employees each week a net pay after taxes, or do I pay them their gross wages?
So you can, you still continue paying your employees as normal, right? So, you know, you keep paying their payroll taxes. The question is, how much of that is going to be used in the calculation of forgiveness, right? So to the extent that you're still, your employees are still on your payroll, whatever amounts you're still contractually and statutorily obligated to pay your employees, you continue to pay them. it really goes into a question of, for you and your accounting group and your bookkeepers, on when you're calculating the forgiveness amount, how much is actually going to be used towards the forgiveness amount. So don't be in a position where you're not paying payroll taxes anymore or anything like that. You still need to pay those. It's really a question of how much and how you calculate the forgiveness of the payroll protection check, or the paycheck protection program. Well,
another clarification, I think, as an owner of a company, can the owner pay his salary if he doesn't take a paycheck but does take a weekly draw as his salary?
Yeah, I don't think that there's going to be a distinction between paycheck versus weekly draw. But the question before was a little bit different about taking a draw now that the PPP loan has come in. But there isn't going to be anything that precludes you from continuing to take your draws once you receive the PPP loan.
Okay. Question, when we first started the PPP effort, the question for certification was more of a challenge, quote, please keep your employees working, end quote, and we'll give you a forgivable loan to cover some of the costs. The certification question seems to have changed.
No, you're exactly right. So that's really the $64,000 question, and that's the concern, which is, and you saw the SBA Inspector General actually came out on Friday and issued a little bit of a rebuke to the SBA in their interim guidelines, which the CARES Act sets forth what the certification needs to be, and then the SBA has come out with all these additional rules and guidance after the fact, and it's really really muddied the water. So what you're seeing is there are lawsuits out there now that are challenging the SBA's authority to limit the amount of 75% of the proceeds being used for the payroll. Questioning the SBA's guidance on what it means to be necessary to maintain the ongoing operations of the business. So I think you're right. There is the SBA has effectively moved the goalposts for people, especially for companies that were really concerned about how quickly the funds were going to be depleted, and applied that Friday night or that Sunday night whenever their SBA lender opened their platform, made the certification under the bare guidelines that or the bare rules that the CARES Act set forth. And now, weeks later, there's been an update in the way in which the SBA is interpreting those rules. So I think you're right that there's some ambiguity and some confusion in what the SBA is actually requiring. So what we've been advising companies is, if you want to take the most conservative approach, notwithstanding the fact that the SBA seems to have moved the goalposts a bit, is to pay the money back. That is the absolute most conservative approach with respect to this certification issue. But I think there are grounds where you can make justifiable arguments that when we made the certification, we were acting in good faith. And there's questions in various courts of law, the guideline or the threshold that the courts will look to is a business judgment rule. The courts will often defer to businesses on whether or not they really know their business and they know whether or not they should be making a certain decision. So the question is, shouldn't the SBA be doing the same thing? And unfortunately, the answer to that is we don't know. There likely will be a significant amount of litigation that continues to come out of the Paycheck Protection Program. But I think the commentator was right on point in saying that we relied upon the state of play as of the time that we made the certification. So shouldn't that be good enough? And unfortunately, the SBA has muddied the waters a bit. It could be good enough, but unfortunately, we're not in a position to really be able to say right now.
And just getting back to the PUA, the question was, do I need to declare PPP to PUA? The PUA is the Pandemic Unemployment Act.
Oh, okay. So yeah, so that one I'll follow that one up to you as well, because that's the Unemployment Act is a little bit outside of my scope. So Dan Schwartz is was very well versed in that, and we can confirm that for you.
Okay, that'd be great. We actually are at near the end of the questions almost, so if we can
Sure.
we'd be all set here. As a follow-up, I think, to the spec builder, says it seems that spec builders do not qualify for SBA loans, but contract builders do. The builders that do both still qualify. So can you carve out, your spec business and your contract business?
Yeah, I think I don't think the SBA. So what the SBA did, or the CARES Act is it says if you qualify under these particular, if you're disqualified under these particular statutes, you're going to be disqualified for the purposes of the PPP loan as well. So I think what we need to do is we need to look to the SBA just generally and make it and see what they would typically do in this situation. If you're able to carve out your spec business from your contract business, I think then on a normal situation, I think that you should be fine from a PPP perspective. But if the SBA says no, this is really one business, and you just have two different divisions, and we're not in a position to really separate them and segregate them and keep them separate without commingling the funds, then it'll be a little bit more challenging. So I don't think there's any specific guidance out there other than if you were going to be excluded in the first instance, you're going to be excluded under the PPP as well.
And then the last question, if a self-employed owner's profit is $150,000, how much can he use in salary to pay himself under salary, $100,000 or $150,000?
Well, the question is, it's not really how much can you pay, because you can still pay, right? So you're still entitled to pay whatever the comp was. It's really going to be what the amount of the forgiveness is. So it's not that the Paycheck Protection Program limits compensation to people in excess of $100,000. It's really, the question is, how much of that is that person going to be entitled to, or will the forgiveness be subject to reduction if that person has reduced their income? Or the other question was whether or not that full $150,000 should be used in calculating the availability of proceeds. So it's not going to act as a cap on your compensation. It just acts as a question of whether or not your forgiveness is going to be reduced, or what your loan proceeds should have been.
Okay, great. Well, Mike, thank you very much for that. It was extremely informative. I think it brought a lot of light to clarify what the PPP program is and what people can be doing and shouldn't be doing. Again, I want to thank both you and Tim for making yourselves and your resources available. It's invaluable information that you provided to our members. So thank you so much for your time and advice. For our members, I just want to thank you for joining. Hopefully you guys found this as informational as we did. This is a series of weekly educational opportunities we're going to provide. Next week, we're going to have next Wednesday, we're going to do, so now that you're paying yourselves, you need to get out there and generate some business as well. So we're going to do some things on marketing and using social media to really enhance your marketing, get the messaging out there. So stay tuned for details on that. We also have a number of non-members that have joined us for this meeting. Hopefully you enjoyed the resources that you heard about, and I would encourage you to become members of the association and join the HBRA. This is the kind of resources and information we provide our members on an ongoing basis, even when we're not in pandemic situations. So hopefully you'll reach out to us and become a member of the association. And then I will follow up with the clarification that Mike gets back to us. We'll follow up with that as well. Mike, I don't know if you'd be willing to share the slides, if we could get those out to the people that were on the call as well. But if you are, we can send those out as well.
Yep, absolutely. Yeah, Eric, I'll shoot you a PDF of those so you can share those around.
Excellent. Thank you very much. Well, again, thank you everybody for joining us.
Thank you, Mike. Thank you for joining us. It's been a great resource. Thank you.
Eric, I think the question is, if we have to buy oxygen for Mike, is that a deductible expense?
We'll have our charitable foundation make a donation to Mike for oxygen and hydration as well. So
Thank you, Mike.
thank you all very much. We greatly appreciate it.